Morning. Hey guys, nice to see you. Before we start off, I will just read out a disclaimer here because this is important that you understand that what I say here is not recommendation or advice, financial advice in any shape or form. So before we begin here, please note that this webinar does not constitute financial advice. Everything discussed reflects only my personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is intended for educational and discussion purposes only. Today's session will last approximately 45 minutes. I'll see how long I'll do the presentation, and then there will be questions and answers. You can ask your questions here now, and then I'll start to take a look at it when I've done a short presentation. And if you'd like to ask the question, then please use the space at the top of the screen and to send it directly to us. And as I said, please note that this talk will be recorded and sent to you directly to your inbox as well. Okay, they say that nobody rings a bell at the top, and I don't ring a bell right now. But what I think I want to do is just to try to make it clear to people where we stand, because I think on a daily basis people can get lost in the narrative and the talks of various people and saying, oh yeah, but this time's changed, things are different. But really it's not. Really, the reality is that things are not different from what we have seen before. And I just want to show a few things here, and then we can put let the discussion run based on that. So I want to get into what we have here, which is it just puts right in the top of things here. I'll put it over here. Where we have the different bubbles that we have had during the times. Where actually there's one missing here, but we had the Tulip Mania in the Netherlands in the 1630s, and people say, "Yeah, why do you talk about tulips?" Because of psychology. This is really about psychology by the end of the day, and the craziness, the madness of crowds is what is important when it comes to bubbles. So the tulip crisis was when the tulips went into fashion back in the Netherlands, and they started to move up. And as you can see, it was not something that just lasted for a day or two. This was something that it went on for a few years. And at some point, it reached the price. One bulb of tulip, just one tulip bulb, just reached the price of the cost of a house. So just to explain, to tell something about the mania of that. And of course, at some point, it just collapsed, and people lost a lot of money there. Then we had the railway mania back in the, I'll just turn this down again, back in the 1840s, which was when the new technology came out. We had that, steam engine came out, and a lot of things, would change. The world would be changed because of the steam engine and because of the locomotive and other inventions that could be based on that. And again, you had a huge bubble developing, and actually thousands of companies started to emerge, and the parliament was behind it. And again, people, because of this technology here, people just thought, okay, there is a guarantee that I'm going to, earn money in this because there's a new technology. What is it there not to like? And again, we saw a bubble developing, and we saw it busting, or it burst in 1847, and a lot of people lost money, and also the UK went into a recession. And then we saw in the Roaring Twenties also, we saw electrification, we saw automobiles, we saw radios coming out. I mean, again, technologies that would revolutionize the world, no doubt about it. And again, we saw people just going crazy about that and just thinking, this new technology is just going to send us to the moon, and they actually did. Well, but it's not the same as it's a guaranteed investment. You can lose money because it's not like you can just say, just because I invest into some kind of radio business back then, it would you would end up earning money, because first of all, the business could be the wrong one. And secondly, maybe it was already into a higher price. And people there, they started to buy in with just 10% down, and 90% was borrowed money. And we know how that went. We had one of the largest busts back then. And then we had the dot-com bubble as well, 2000. And again, we heard, how this time is different. The narrative was new economy. And if you don't get it, then it's because you really don't understand it, because it's like, this is the ship. And you saw how businesses were the darlings of Wall Street, the darlings of the media. You have Webvan, you had Pets Food or Pets.com or petsfood.com. You had all of these, and I think it was 16 or 18. You have to forgive me on the number there. 16 or 18 of these uh, .coms that were on. I think it was in the Super Bowl in 2000 or it was 1999. Forgive me on the years here, but this is a true story. And I think was it 18 or 16 of those that went bust by the end of the year. That have all been commercial, the big commercials on Super Bowl that year. So that things are exploding and people are just talking about it, and it's consuming everything is not the same as that it's going to create wealth, that is going to create wealth for you in the investment you're in. So I just want to, say that to you because you can't, these bubbles are something that we see again and again. And we also have the South Sea bubble here, which I haven't put on here, which was also a massive bubble, which was in the 1740s, I think. So bubbles occur and again. And very often there is a technology coming out, like in the Roaring Twenties, like in the railway mania, like in the .com, where that is the driver of things. And people think this is a sure investment because new technology. And this is what we see again now. And this is what I want to be so. That's why I'm so critical when I see my tweets on X, because people simply stop thinking. And when we look at something like this, with this is the Nasdaq we have here, and we can see how we're up 21 to 22 times, no, not 100%. This is 21 to 22 times we're up. So 2,200% in that amount of years. I know in these crypto days, that sounds like, oh yeah, that's just a 2-3 days of rally or something like that. It's because crypto is just going insane. But this is actually quite unprecedented. And when we look at the market cap to GDP and we take crypto into it, because crypto is also a risk asset, then we have a market cap to GDP, which is 226% at this point. It was 86 and we had the big bubble in 1929. It was 136 in 2000, and it was 107 in 2007. This was considered an insane bubble. And now we are we're working on getting up to the double of that size. So, and if you look then at, and this is the Nasdaq, and if you look at Nasdaq also, when you look at it from even if you adjust it for the M2 and say, yeah, but all the money printing and all that, well, even if you look at it in that kind of perspective, you can see now that we are actually looking at a bigger bubble than we have seen before. And when we look at this, and now we had Nvidia coming out with earnings yesterday, and barely just brought it home, the earnings expectations. But look at this. This was considered a crazy chart in the days. This is Cisco 2000. It was the greatest bubble asset in the world. It was the highest valued company at that time. And look at what we have now with Nvidia. It's up 450,000%, and that's probably from around down here. So let's say over the next 10 years. This is not a sustainable development. I just want to say I have nothing against Nvidia or anything, but this is not a sustainable development. It takes up, I think, 10% now of the S&P. It is insane. We are in the largest financial bubble that we have ever seen. And this is not just about tech stocks. This is also when we get into housing. And I think there's a lot of people that actually do not understand that we have also a housing bubble at this time. And this is not my chart. This is the out from Venture Consulting. So always credit where credit is due. And if you look at here, U.S. home price history, 1890 to 2025, you can see now that we actually up here on the home price index on the inflation adjusted home prices, way above where we were in 2006. So it's not just a matter of, it's just not just a tech story here. It's a tech and a housing bubble we're in. That's why I call this the 1999 meets bubble of 2007, because you actually have these two components. And there was one thing that the economy does not like. That's when a housing bubble bursts. Because when the housing bubble bursts, that's when you get the largest deflations. That's what we saw in 2007. That was the that when that bursts, then you'll have a lot of balance sheets that goes wrong in the financial sector, and you'll see a lot of money just falling into that. That did not happen in 2001. There you actually saw that the recession was actually more shallow because you did not have a housing crisis. This time around, we have both. We have the largest financial bubble because we have a housing bubble and we have a tech bubble. And then I'll say as well, we also have a crypto bubble. There's nobody that can tell me, and I know I make a lot of enemies when I say this, and this is again back to what we've seen before. When you are standing in the midst of it, people will not like what you talk. If you said, "Oh, the .coms, they are air." Oh, Henrik, it's not about what they earn. It's about how much they spend on marketing. You don't understand that. This is a new economy. That was what we said 25 years ago. Now we say, "Oh, Henrik, it's because you don't understand Bitcoin and you don't understand that this is a technology. This is shifting. You don't understand Bitcoin." I understand Bitcoin. It's not that difficult, I can tell you. It's not that difficult. And people say, "Oh, yeah, but you understand that there is a fixed supply." Yes, I get that. But that's not the same as it can have an unlimited, price in terms of, the price on it can be just going up forever. So we are in what looks like a gigantic bubble that can be developing still for some months to come. And if we look at it here, we see how into the final phases of 2017, 2021 here, we see how it actually just explodes higher. Here we were around 750 million. Here we were around 3 trillion. And now I think we can reach 9 or even 12 trillion on crypto. It does not tell us that it's actually not a bubble. It just tells us that it's insane. And if you look at it technically, this actually tells us that we should be very careful when we start to get up there. I'm very bullish these things right now. And I say there is going to be an alt-season, all that. We're going to see it. But come the time where I think the dollar is starting to rise, then I think you need to be very careful because we have simply the needle that will prick that bubble. It's going to pop it, and it's going to be really bad. And when these things are starting to unfold, the housing bubble and the tech bubble and the crypto bubble, it's going to be bad. So I really just want to, enlighten you on this or tell you about this, and then say that every time somebody tells you that this time is different, you can go back in history, and the financial graveyard is filled with people that said this time is different. It is not. There is a technology, the ledger, the blockchain, and all these things will there'll be some fantastic businesses coming out of that. But just like in the .com, 99% of them will not be here. And they will also go through a horrific market decline. If I see it right, I think there's a pretty good chance that we could see a 75 to 80, maybe 85% decline. We saw that in the .com days. And this time it's going to be bigger because of that. It's a double bubble, so to speak, or triple bubble. So be careful. And that's what I want to say with this. And now I actually want to stop and I want to take some questions. And then, let's see where that takes us. All right. Let me just see if I can get the questions out all here together. Hang on for 1 second. That was not what I needed to press. The Q&A is right there. All right. I'll go through them. Isn't the timing of such bubbles erratic, unknown beforehand? E.g., the tulip bubble lasted for 16 years. I don't think it lasted that long, actually. It lasted 4 years or something like that. No way to predict them when it's finally over. And secondly, what makes you so sure that the past safe haven assets, i.e. the US dollar and US government bonds, will perform in this downturn? Could it be the case that this bubble bursting fully erodes the confidence in the US dollar bond this time? Fantastic questions, Sasha. And I want to say, first of all, what pops the bubble is recession. And the recession is based on business cycles. And that's why I start with the business cycles. So when I look at my business cycles, and I can see that we are closing in on getting a crossover bit of the coincident indicators that I tell, which is the real economy. We'll see if there's some confirmation here in September. And we start to see that the imminent recession indicators, and those are related to yields, to yield spreads, to credit spreads, and so on, starts to rise, then I can tell you that we may not know it, but there are indications of it. How do you know it's going to rain when you go outside and the sky is all dark and you can see that there are thunders in the distance? You don't know. It may, but if there are enough indications, you probably want to get ready for it, and you bring that umbrella with you, or you maybe even stay at home. So it's not erratic, and there are levels that will be reached, and this is where Fibonacci's and the likes can help you also. But the recession is going to pop this bubble, and there's another thing, and that's the dollar. And you say, yeah, but you don't know. There's technical ways of looking at things where you can actually say the dollar is going to have a massive rally. And I can tell you that if the dollar reaches 105, the Dixie, I mean, or 110 or more, which I think it will, I tell there will be a massive havoc in crypto land and other places. So honestly, I back to your question. You can look at it, and there are ways of actually getting in under this. We never know, obviously, that we don't have a crystal ball, but we have indications. It's like we never know why the butler, if the butler is the murderer, but if you have enough indications, you can actually, with a certain amount of probability, say that this is going to happen. So yeah, I don't know the day or anything like that, but I can say there is a time for me to say, okay, this is getting closer now. I'm not out of the risk asset, but I'm just saying it's getting closer, and it will be a very bad day when it starts to develop. Then it just also, I think it's actually a good question also, the confidence in the US dollars and the bonds this time. Good question also, because you may see that all of that could be true, and you can see also the downgrade of the US debt. That is actually exactly as you put it, something that could the confidence can be lost. But it's always a relative thing. And if you look to the rest of the world, where would you rather put your money? I would probably say there's nothing, no place in Asia, no, it's not anything against any Asian countries at all. There's nothing. It may be the European, EU, but even there, I live there. I tell you, there will be this, there are so many asymmetric structures that are wrong with the euro, that again it'll be a relative game between the euro and the dollar, and I will say that the dollar is still the cleanest shirt. Also, when things are starting to unfold and so much money is already in the US dollar, the debt is there, and if that needs to be restructured, you will have to see that it needs to go through the dollar, which means that you have to close that loan or for the refinancing or restructuring or the defaulting of it. So all of this will require dollars. That's why the dollar is going to spike. And I think it's also we're seeing that also in the structure, the technical structure. Um, mm, Honestly, there's some question here like that. Okay, your forecast sometimes coincides with David Hunter's, which he doesn't like. It's because you arrive at similar conclusions by different methods. I actually invited him. I said to him, let's look at. I think it's interesting that we do, and all of you guys here, and especially those that are our clients and so on, you know how I do my stuff. I mean, it's out there. So I've never seen a chart from his side, but why don't we just talk instead of this? He'd rather just say that I steal everything from him. But I think I'm doing a pretty good stealing then, and even putting it up for our clients to see then. Anyway, I don't know how he does it. Haven't actually seen any of his anything from him in a long time, and he's also blocked me and so on. But I don't know how he does it, and it would be interesting to see from a academic point of view to simply see how could we possibly come up with the same kind of direction of things and levels. Okay, as mentioned yesterday, I would like to get a better understanding of why you believe EV technicals aside, gold will be dragged down with shares to begin with. Because if you think about it, as I just said, if you're going to have a housing crisis, you will see that there will be defaults, and defaults will bring the dollar off the Dixie up to 120, around that level. And if I'm right on that, then you're going to see precious metals actually declining. And everybody say, yeah, but the capital rotating to gold. Hey, listen, the capital will evaporate. The thing that people don't understand is that it's not like fixed size of capital and then it rotates around. It's not like that. Majority of what's in crypto will be lost. I mean, there will be more losers than there are winners in crypto by far. So it's not like that, capital is just circling around. The same goes for stocks. There will be a lot of losers there. And you will see that, people thinking that they have a portfolio of a certain size will all of a sudden have half the size. And that's why, it's not just about that. And when you need liquidity, and there was a situation here not a few months ago where there was rumors said there was a hedge fund actually almost going under, and they had to sell out whatever they could to just stay afloat. And it seemed like gold was also one of the things they sold out. And I just say, when the sovereign debt crisis comes up, and I think we could see that. Remember, Greece that we saved in Europe has now a way higher debt than it had in 2012. And that goes for the rest of the world as well. So we haven't solved anything. And that means that there will be liquidity shortages. There will be, and that's in the dollar as I see it. And that's why I think, but do I think the gold is as important? Hell yeah. I think gold is more important than any crypto you can come up with, even Bitcoin, also Bitcoin, especially Bitcoin. So it is, gold will have its shining day, and it already had, you can say, but you have not seen silver and gold miners and so on go with it. And I think you're going to see that they will all sell off into that deflationary part, and it's going to be really bad. So I see. All right. What else? Asset allocation, I can't talk about that. Could you please look at Nifty India? No, I can't do it. Henrik, have USD already bottomed? I don't think it has. I think it's in a bottoming phase, and that's quite different. And that's where people say, "Oh no, no, it drops, or it comes up, oh, it drops, or it comes up." And it's like it's to bring most people on board on the bearish side. And when we have the screaming of the dollars collapsing, then it's probably when the time. But I don't think the bottom is here yet. Do you still believe an altseason will occur given the deteriorating economy? Yeah, because you have a setup where there is the Bitcoin dominance index, and you see that is actually putting in what is a very, very large top. And a very large top, and that will mean that Bitcoin will decline versus Ethereum and the rest of the pack, and that everything else being equal means that you're going to have a fantastic alt season. But I know, just think about it. 3-4 months ago, before Ethereum started to move, everybody had, were saying, "Oh, Ethereum is not going to, it's dead, it's out. Don't think about it anymore." Now everybody's saying, "Oh, it's all about Ethereum." And soon, actually, now we can start to see Solana moving, and it will probably not be far from seeing people, "Oh, Solana is the shit," and it's like that. That's the rotation that's going on, and the rest is psychology. Do you see the euro surviving the bust? Yeah, I do see the euro surviving the bust. I think there can be some asymmetry in the Eurozone, which will be very difficult to handle, where you see that there will be the northern part and the southern part, and you'll have to have that the northern part will actually at one point accept the debt of the southern part be in order to actually to have the euro to exist. The problem with the euro is that there is really no valve in it, and so the way you normally would have a currency like that would be that if there are starting to be problems in one area, you then see that there will be some transferal of money to that. We don't transfer money. We don't give them money. There'll be the Germany. Germany, Greece, let's put it up like that. You'll see that Germany lent Greece money, and that's not enough. That's just pushing it down the road, up kicking the can. If you are in a tech stock and own a home, and it's not feasible to sell either type of asset in your currency trade, how would the normal investor try to protect themselves for a 1 to 2 year time frame? I don't know. I mean, if you're in tech stock and it's going to decline, I don't know how you're going to, you'll have to figure out if it declines to 85%, you'll be going down with it, I think. Is it safe to invest in USD stablecoins during the bust, or should we just hold USD in the bank accounts? Everything that has to do with crypto or any crypto related at that point when that starts, I mean, it's about the dollar. It's about the dollar. This is liquidity. This is about people, buying. You cannot buy anything with the rest of it. You may be in this world where we live in a bubble, but it will not be the same at the moment when the bust goes. So I would not be holding anything like that. Lynn Alton and others have said money is lost preparing for recession than during. More money is lost than preparing for recession than during recessions. How should we hedging or lowering risk considering the bubble could continue inflating for 6 to 12 and 18 months? You're right, Ross. But remember, I did not say in 22 that a recession was coming. I said I said we're going to see the recession is not here. And in 22, everybody thought it was when we had the inflation and we had the decline in the markets. I said, no, go back to my tweets. 23, when we had the Silicon Bank also declining or having a bust, having to be saved. We also heard people say, oh, now we have a banking crisis. I said, no, there's nothing, it's going to go much higher. 25, Q1, everybody, oh, even BlackRock CEO said, oh, the recession may be here. I said, no. This is where the business cycle works. So when Linolden and others are talking about that, that's because they don't follow business cycles. So they have to wait and see based on what's coming out in terms of other, whatever indicators. But the business cycles are telling us where we are in the cycle, and that's why they are extremely important for investment. So I'm not starting to hedge or lowering risk just yet. Remember, I'm very long risk at this point, but I know what is coming, and I know what I'm looking at in terms of what indicators needs to start flashing. Up, up, up. Let's see. Focus on making money before the blow off top. Why do the charts say that alts are supposed to be in an explosive wave 3 or 5? As I said, it is again, alt performance shows zero momentum per Swiss block right now. Right now. Remember the rotation, as I said, Ethereum, Solana, and the likes, and then they comes down the road. How about the financial sector? Is that in the worst shape since shaped than the 2000 worse shape than 2008? I don't think the US is necessarily in a worse shape. The problem is that when you have multiple bubbles going on, that it is going to hit the banks. So especially that's why the bigger crises are when you have recessions where you have a decline in the housing market. And currently, if you look at the NAHB and so on, you look at affordability and so on, the housing market is in really bad state. So if people start to lose their jobs, there's a lot of people that'll have to sell their homes and they'll probably not even be able to pay back their mortgages. So yeah, the financial sector will get in a bad state. You're not in a bad state right now with this financial sector, but you have to ask, what about their customers? And we're talking about here 15.6% in a new survey of US customers are not capable of putting food on their table, have severe problems in bringing food on the table. That is a big number. It's bigger than into the financial crisis. So it's not about if the financial sector is in trouble right now. They will get in trouble. That's it. Where does it go the next 5 years? I see it down a lot into the deflation, and then I see the Fed and Bernanke coming out with the guns. And then I think they're going to start to see stagflation, and I think we're going to see gold explode. And if you ask me 10 years from now, I would say I could see gold at $35,000 an ounce. I could easily see that. There's something. Okay. Can please an update on Mara? That's a little too specific here. How long and how many steps take to crash? Well, you just look at the crisis of the decline you had in 2001. I mean, it was pretty fast, right? So when things are starting to unfold, it's just in fear grips. We are only, what is it now? It's August. Remember in April, see how fast fear just got hold of people, and we were only down 20 some percent. Think of it if it's down 30%, and think of it if the dollar's just going vertical all of a sudden, if I get it right. So I think that it's it can go fast, really fast. Yeah. So with deglobalization pushing the price of goods and having inflationary pressures, do you still see interest rates being slashed during a recession? Where are the inflationary pressures? I know people talk about it, but there are no inflationary pressures. The inflationary pressures were there in 21 and 22. Right now, you're seeing inflation getting pushed lower. And you're actually seeing that inflation is lower than it was going into the 2007 situation and 8, and in 2001 as well. So there's no inflationary pressures. 2.7 is not inflationary pressure at all. So there's no inflationary pressures. I just want to put that out. It's simply because inflation is a lagging indicator on lagging the business cycle. So when the business cycle rolls over, you'll see inflation rolling over. And right now, you're starting to see the business cycle rolling over. So inflation comes later. And what you see right now for inflation is what the business cycle was doing 3, 5, 6 months ago. So that's why people are all over. Like, there's inflationary pressures. There are no inflationary pressures. Actually, on the contrary, look to housing, rental. Does not look good. So I don't. So this about that rates being slashed, they get crushed. Remember, it's not the Fed who sets rates. It's not. The Fed follows the 2-year yield, and the 10-year and the 30-year, they follow demand in the market. So that we have this notion, oh, the Fed. No, it's not. The Fed really just followed. Go check it. Every time the 2-year yield drops before recession, you see the Fed follows. Do you have any timing and indication of when the bubble will burst? How long do you think this could downturn could last? Well, there are, yeah, I think there are, indications that we are not far off. I said in April that we will have an extreme rally and a V-shaped recovery, and that is what we have had. And we are now getting to levels where I think there are two ways out of this. That is that we have a summer doldrum, which is not really coming to be summer doldrum so much longer because summer's almost over here, done here in Denmark at least. But but probably a kind of a push lower fast, which could come by the next FOMC. Maybe they spook the markets. Maybe they do not deliver the cut we want. But I think that it's a risk that we see a fast decline before we head into the real and the last high. I'm a little in doubt about this. Where are we going to see? Because we also know that when the Fed starts to cut, when they start to cut, we are closing in on the market top, and that is really what I think we could be getting into here now. What is the normal length of a business cycle? There's not a normal length. There's not one size like that. But there are certain phases that you go through with that, and these are very recognizable. So you can say that. But there's one thing that is for certain, and that is that the easy money policies and all the BS that they have been putting on us from the Fed side and from the central banker side, that you can just pour money on everything, and then you're going to make it all fantastic. That has extended the business cycle. But the problem is simply that they may have blown the bubble even bigger and into more areas. But that does not mean that they can simply prevent a recession. And when it goes, then it goes much bigger. And this was actually also the point of Ludwig von Mises. He said there's only one way out of a boom in the economy, which has been brought about by a credit expansion. And that is either by a voluntary pop of the bubble, or where the total financial system comes into danger. And I'm saying this time around, that's why I also had another article on Substack also, where you could see that we are over the last 100 years, we have had 4 times when the SPX and gold ratio, so SPX over gold, has broken lower in a significant way. That was 1929, it was 1971, it was 2000, and it's now. 1929, it was a huge bubble. So it's really the trust of the whole of stocks and so on, the financial market, you could say. Then in 1971, it was kind of a little different because that was not the bubble stock market topping out like that. It was really Nixon who took the dollar, the gold convertibility off, the dollar gold convertibility off, and that actually questioned the entire financial system. And then you had 2000, where we were back to like in 1929, it was like the stock market, but the financial system kind of were. Now I would say we are closer to the point where we're seeing actually both of these again. We have a crazy stock market top, and we have a stock market bubble, sorry, and we may also have at least serious doubts on the financial system. So I think we should be very, very. There's a lot of indications that we could see a very big bubble here bursting, and that'll also be much worse. Let me just get some water. See, then you have I love the next question here, Iker. How does this crash prediction correlate with global M2 rising and further rises predictions for next year? Let me just show you how it actually correlates, because this is the greatest. There is only this thing also, don't fight the Fed, where it's actually you should fight the Fed. Every time the Fed goes one thing, you should actually, go opposite. But let me just show you this one, actually, because I think it's quite interesting to see. Let me just see here, share. Now you tell me. Shoot. Hang on. Let's see. We have it here. Something liquidity. Liquidity is not enough. I can't find it. I just closed it down in my eagerness. Okay. But what I want to show you then, let me see. I can find it here then. I think it's here as well. So what you're saying is that why would I think markets can crash when liquidity goes up? Well, because I've seen it before. Liquidity does not drive the business cycle. And there was a chart also by Steno Research or whatever it's called, and they showed exactly the same and trying to say that because liquidity is moving up, you're going to see the market can crash, you can't see the recession. But it actually showed the opposite. And what you see is that into the .com, you saw liquidity moving up. And this was quite strong back then. We have to understand that these are now much higher levels. This is M2. Then into the financial crash, you saw this. How could we see this? Is that what you're asking? Well, because we have seen it before. Because liquidity cannot counter a business cycle rollover. So when the business cycles roll over, it does not matter how much liquidity you put in it. And there's actually there's also a very famous chart going around on X showing exactly the same. And people say, oh, but when the liquidity bottoms out, then you have a fantastic bull market. And then you see how liquidity bottoms in 2008. And then I said, hey, don't you understand in 2008 and 9 was actually a very bad year? So in terms of the stock market, at least until March in 2009. So it goes very well hand in hand with that. Just check it. I mean, it's right out there. Will you buy BTC at the bottom of the crash or only gold? I will have to see what Bitcoin does because I don't think people really understands that we are in a situation where Bitcoin could crash to much, deeper levels than anybody has seen before. This is not an ordinary cycle. Bitcoin hasn't met a real recession. It hasn't met anything near what we're going to see at this time. And if we really see that the economy rolls over at this point and the dollar hits 120 on the Dixie, I can tell you that we're not going to see that Bitcoin is going to do well. But let's see. I know that we have a framework, and that framework has been quite fantastic in actually making sure that our clients and ourselves are out of Bitcoin at the times and also getting us back in again. So it's about understanding that a cycle behavior, and I think that is what I'll see. I'll have to see how deep it goes, but there will be a lot of havoc in crypto market and also in Bitcoin. All right. What else? Do you see Bitcoin moving higher this year, or are we already moving on an alt season? Well, I think no, Bitcoin doesn't move top. I don't think Bitcoin is top just yet, and our system actually took us out into this decline here as well, and it's not really taking us in just yet, but it will. It will when it does. And we will have to see where the final top will be. There is this. I think it can go with the Bitcoin cycle that we have, and that can be also when we potentially see the Bitcoin top. So I think there's one or two more tops coming to it, and I still think that markets could go much more, 40, 50% higher from here without a problem. Okay, let's see else. What else do we got? How long is it going to take till the next bear market? 18 or 13? As I said, my crystal ball, it doesn't work right now, so I don't know. That's where I have to turn to the business cycles, and again, those are the ones that will give us the way we go, and if we follow that well, then you can also make better returns over the long time frame. Okay. Will we print more money than COVID? How long does it take for housing to recover housing prices then? I think because we will probably see that there will be a need for real assets, and I think you're going to set off a commodity boom after this. Why? Because I think the money that has been circulating and everything else will need to find proper use, and I think if we see some kind of stagflation because of what the Fed is trying to do, then I think there'll be a speculative bubble in commodities starting, and that would also include housing. I think actually housing can maybe take a dip. I don't necessarily think it's going to be as bad as in the financial crisis because we did have there also a lot of more speculation in housing as such. So even though it's a bigger bubble, I don't think the crash will be necessarily the same because people don't have 3 homes and 5 condos. So I think that is going to be soften be cushion the fall a bit. But I think over the long time frame, I think houses can do quite well. So it may take a couple of years 3, 4, 5 years, and then you see things will be coming up again. So long time housing will be good, even with if we get inflation up and running at 3, 4, 5%. Let me see what else we got. Yeah, how does this? You said that. Do you have a view on quantum computing threat to BTC? No, I don't. I'm not the right one to ask about that. That's technical questions. I'm not. What do you think about emerging markets, Brazil and China? Do you see a migration to rebound of that for the change of cycle? See a migration to rebound of that? Not really understanding the question here, but how do I see the markets? I think you're going to see Brazil and China actually doing really well here. You see emerging markets actually, that's also one of my expectations into this blow up top, that you'll see emerging markets actually doing really well, but also getting to a really high, important top. And if the dollar, again, everything is about the dollar. And if the dollar turns into a hit, 120, as I think it will, you're gonna see those emerging markets getting crushed. So I think it will be it will be a good investment for the next few months, maybe, and then you'll see a very, explosive investment actually even, and then you're gonna see them come down quite strongly. Okay, let's see what else we got. The Bitcoin code base will get updated, and when any threat from quantum appears. Okay. I totally agree with you. However, some of the macroeconomists are saying that U.S. government cannot afford a blow-off and will make everything in their power to avoid it and avoid the transfer of power to emerging countries. I mean, if it was that simple, if it only was that simple, it seems like, some macroeconomists thinks that the U.S. government is in charge. Just let me tell you that there have been many US governments over the years that have overseen quite severe recessions, and they have been able to do nothing about it. The Fed has been able to do nothing about it because when the bricks, the domino starts to tumble, there's not much that can be done, because it's a momentum. We are talking, and 8 trillion people, sorry, 8 billion people, 9 billion people are now on the globe that are starting to move in a certain way, not spending and so on and so forth. So it's not like it's not something that the US just or any president can do. And I just want to say here that I think Trump is going to own this crisis, but he's not the one that is the culprit. The culprit, by the end of the day here, are the central banks that thought they could print money and print wealth. And that is the problem. And I hope history will understand that at some point. Okay, guys, let's take 3 more, and then I think we'll call it a day. Just to play devil's advocate. Okay, on the classic, this time is different argument. Is there a plausible case that the unprecedented concentration of balance sheet strength and capital deployment by today's largest institution could extend this cycle far longer than prior bubbles? Treasuries as a stabilizer, could persistent treasury demand, direct and indirect, provide enough structural support, blah, 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 asset management flywheels, with firms like BlackRock, blah, 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 all this. Guys, it's about Mrs. Johnson. Forget BlackRock. Forget Wall Street. This is about Mrs. Johnson. There are 2 components in the economy today. There are the financial markets, and then there is the real economy. The financial markets, they come up with all these 3-letter abbreviations and saying, oh, now we do this and, QE and whatever, all this, and this is going to change the day. No, it's not. It's not. It's about Mrs. Johnson actually going out there, taking a house loan or mortgage loan, and actually can see herself in that, being able to pay her bills. And if she cannot, then all of a sudden there will be 200, 300 million Americans that will be in trouble. There may be a 1 or 2 or 5 or 10 million that are living, the days of, the fantastic days and, just flying. That is not going to save the economy, and it's not going to save the financial world. The financial worlds keep believing in that. But all this is BS talk. You've had already the extension of this. You've had the extension when you're seeing the QE coming on again and again and again. And now I want to say it. This time is different. Why? Because we have seen inflation. We have seen inflation going up from nowhere, from low levels. And whatever the Fed did, there was no inflation until the geniuses, they started stimulating into a supply crisis. I mean, at least in Copenhagen at the economic study, we learned that supply and demand. And if the guys who are actually delivering the stuff are going home, and you then stimulate the demand, just giving everybody a stimulus check, well, then prices are going to go up. And they said, well, it's not going to go above 2.5, 3%. I think Yellen said that. And then we had 9%. What happens with inflation is that it gets into the backbone of people. So people then get, oh, we actually can have inflation. And and then they start to fear it because it's not good. It's not fun to have inflation. And you can see that the levels of the groceries that you buy, they have just risen and they haven't come down again. So this about that all of a sudden, everything will just be, different. And because you will have some financial institutions that may support this and that will change the world. Again, it's 8, 9 billion people going in a one direction. And that is not something that some, BlackRock or anything can go do anything against at all. You may hear some economists talk like that. It's not the way it works. And this is the difference actually between real business cycles to understand the real economy and understand all the BS from the financial side. And the division between the two is becoming bigger. This is the world that used to talk in this is the QE days. And now the liquidity, we will have it. We'll see it. We'll see whether the business cycle will turn or roll over, and we'll see whether the financial world and the QE and liquidity, as I call them, the liquidity test, actually can do anything against it. I say they cannot. So it's not going to be different this time. All right, guys. How high can mortgage rates go post bust? Well, look at it. Look at what you saw into. We had a top, I think, around the early 20s or something like that. And then we have a decline into the what was it, 40s, 50s, and then you saw a rise into the 1780s. What we are at now, right now, is that we are coming out of the bottom of that, and we can see that mortgage rates can go much, much higher into the next 2 decades. So this is we in 2020, that was the point of Volcker in 1981, where the inflation then was started to decline. And we're now in a situation that is quite the opposite, where we start to see it going up. So they can go a far way up. So at some point, not right now, I think it's about fixing those mortgage loans if you can do that in your country, and then just ride that rate for it, because the days of ever lower rates yields are over. We're going to see a bust in them, but it's not going to stay. All right. I know we're at the top when people start physically threatening me for having a negative opinion. Yes, correct, Christian. I think you're right. We're not quite there yet, and I think it's but yeah, we are there. How do you stay in such a great shape? Is that to me? I don't know. 4 or 5 times training for every week, and I'll go again tonight. So that's it. Oh yeah, let's take this a while. Can a massive spending on AI push off this coming recession? No. First of all, AI is going to change the world. It's a new technology, as I said before, with the bubbles in previous times, and it's going to change the world, just like the locomotive, the steam engine, the like radios, like cars, like electrification, like the internet, and all that have done over the years. But it's not going to save the day. We are still at we're still at the highest. We still have the greatest bubble we've ever seen, and we will see that is going to break and bust. And when it does that, AI can do nothing about it. We will see that it will actually be a solution for the future, but it's not going to change anything in terms of the short time for markets. So that there you have it. And especially when it's already been bought up like it has. I mean, just look at Nvidia's stock. It's a crazy ride, right? So, okay, guys, I think that's it for today. We'll try to see if we can do more of these in the future. So thank you very much. And have a good day. Happy trading and take good care. The bubble top is near, as I see it. It's a few months out. Thank you.